Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team in New York City.
All right, let's talk about these markets and some factors that people think about. And if you think the market is going to continue to run, it's going to continue to be good, you're going to be very greedy or very optimistic. Right? If you think the market is peaked, or we're past the peak, or we're about to peak, you might be a little more fearful or a little more pessimistic. So I have two friends that are going to help me describe this fear versus greed dynamic. First one, Homer. Right? Homer's very nervous, very frightened, very pessimistic guy generally. And who's the perfect counterpoint to show greed? Of course, it's Mr. Burns. Right? So any fans of Bart Simpson in the room? So fear versus greed, Homer and Mr. Burns. So why is Homer fearful? Well, land prices. In the periphery, land prices are starting to experience some pushback. Great sites, good locations are doing well, but around the edges, around the fringes, secondary, tertiary locations, land prices are stressed. Hotel market. There are dynamics in the hotel market today where we have a lot of clients who bought sites to build hotels that said, you know what, not feeling so great about things, maybe it's time to sell this site. It went up in value nicely, I could take advantage of that. And the hotel market is the market that has the most dexterity with regard to moving with the market. Leases are only for one day, so you can move very well, but there seems to be some stress in the hotel market. Condo market, right? It seems like every project in Manhattan south of 96th Street is projecting $2,500 to $3,000 a foot, which, if that's the meat and potatoes price of a condo, you have to be making millions to buy one of those. So how many folks are going to buy it? And we've seen somewhat of stagnation in that price point at this point in time. The condo brokers will tell you that it's because of a lack of inventory. Well, there are thousands of apartments on the market, and even though on a relative basis there may be less inventory than there has been in the past, there's still a lot of inventory. Stuff is moving more sluggishly. So, condo market, it's affecting things. Cap rates. Again, we saw that period where cap rates have increased for 2 quarters in a row. First time that's happened in 19 quarters. Prices per square foot up 3 quarters in a row. Perception in the market. A greater percentage of people are perceiving that the market may have topped out, about to top out, has topped out. And activity levels. If you talk to brokers who are active in the sales market, they will tell you that it is becoming more and more difficult to get transactions done at expected pricing levels. It just is. The meaty part of the bell curve where most offers reside is moving down. Where transactions are getting done, staying relatively in line, but it's tougher to get folks to those levels. So that's something that's making Homer pessimistic. Corporate earnings. Look at the stock market. Right? Stock market has basically been flat. Today, I think this market was down, losing all of its gains for the year. But equities are having a tough time. Corporate earnings, with the exception of some very large tech firms, most corporate earnings have been disappointing. GDP growth, we're going to talk more about GDP growth in a second, but has been only 2.2% over the last year. That's mediocre at best. National debt is a killer. And this is more of a macro consideration, but you look at the national debt, 18.6 trillion in debt with the GDP of 18.1 trillion. The first time we've ever had a debt to GDP ratio in excess of 100%. If you break down the debt that we have, it's $7,500 per person in the U.S. is the annual interest that every one of us owe. We pay $7,500 a year each in just in interest. The share of the debt is $205,000 for each of us, $806,000 in debt per family. So unfunded obligations, another thing that makes Homer nervous. No one seems to be addressing it, but we have 118 trillion in national assets, 100 trillion just in unfunded liabilities, and you look at what the liabilities per taxpayer are, over $835,000. These are things that need to be addressed. Doesn't appear that anyone in Washington is willing to address them on either side of the aisle, but something that could have a significant impact on the economy. So let's get to Mr. Burns, right? Why is Mr. Burns so optimistic? Well, the massive amount of capital that is in the market that is looking to purchase investment real estate. It's remarkable, all-time records. There's a lot of stuff up here. What I want you to look at on this chart is these three colors. This is in New York City, the amount of mature Asia market capital coming in, emerging Asia markets, and China and Hong Kong. You look at, out of a total for the year 2013, 7.9 billion came in from overseas, 19% of it, or it came in, that was 19% of the total market. About half of that was from this section of the world. It was a little less in 2014, but this year, this is only through half the year, we're already at 9.7 billion coming in, and the share that's coming in from that part of the world is just incredible. So the amount of capital that is looking for properties in New York City is outstanding. So that makes Mr. Burns feel good. Second thing, where else are you going to deploy capital? Rates of return on so many different investments today are so mediocre that if you look at investing in treasuries, very low cap rates on real estate look great. So one of the things Mr. Burns feels great about is where else are you going to invest other than in real estate in New York? Macroeconomic factors. There are 6 that we're going to talk about in much more detail, but generally Mr. Burns is feeling pretty good about those. Low interest rates. No one can argue that we've had an extraordinarily low period of interest rates. The equities market, from Mr. Burns' perspective, he's going to look at the equity markets and say, look what's happened since 2009. Equities are doing great. And the better that market does, the more capital folks have, the more capital they can spend, better for the market. Supply demand. Supply demand has Mr. Burns feeling great also because there's a very low supply of available properties in the marketplace, and there's all this demand looking to buy it. That imbalance is so acute that it exerts tremendous upward pressure on property values, and there's no end in sight for that. Oil and gas prices, right? Oil and gas prices are so low, we spend less of our disposable income on gas and oil. That leaves us more money to spend. In fact, if you look at this chart of U.S. oil prices, you see today oil's about $44, $45 a barrel. Every $10 decline in oil prices frees up $30 billion of disposable income to be spent in the economy, and that's what's projected, is that an additional $30 billion will be spent on goods and services over the next 12 months just because of the price of oil. You look at gasoline, now we're averaging about $2.25 a gallon. Those things are very good for the consumer. And number 8, plentiful financing. Now, in this market, banks have not gotten too aggressive as they have in past cycles. They still have been pretty good about the loan-to-value ratios that they're willing to lend at, and there's plenty of money available, and to the extent that banks feel good about their exposure, their loan-to-value, there's still just absolutely a ton of money. So for those reasons, the optimists are feeling pretty good about where the market's going.